attorney Laura Anthony, founding partner of Anthony P. LLC, a full-service corporate securities and business transactions law firm. Today is the continuation in a LawCast series talking about the under 300 million class of public companies. Since most companies with less than 300 million market cap are not included in any major indices nor receive widespread analyst coverage, there is less aggregated information on their board composition and governance practices. The IRRC report that I mentioned in the first LawCast in this series examined 160 companies representing approximately 10% of this company class that are traded on U.S. stock exchanges. 73% of those companies trade on the NASDAQ, and the balance are on the NYSE or NYSE American. Of the 160 companies, 3/4 have been public for more than 5 years, illustrating that not all small public companies are early-stage growth companies. Only 14% of the companies were still led by their founder. Although the IRRC report didn't address the reasons or meaning behind these numbers, I think it makes sense in the overall corporate ecosystem. Very few companies will successfully grow to large cap entities, nor should they. High growth models come with great risk and can often lead to a total business failure. For instance, a company that goes public with a 50 million market cap and then grows 10 to 20% year over year will still be under 300 million, the 300 million market cap in 5 years, but also will likely have strong infrastructure and internal controls and provide steady growth to its investors rather than the high risk, higher speed growth. Furthermore, the majority of the companies are in industry sectors that lend themselves to either slow growth or have seen dramatic industry change over the last decade. 30% of the companies were in the healthcare sector, which notoriously has a very long research and development pre-revenue life cycle. Finance companies comprised another 18%, which sector has transformed post-Dodd-Frank, which was enacted only in 2010. Rounding out the industries were consumer goods and services with 15%, energy and utilities with 11%, basic industries and transportation comprised 10%, capital goods 9%, and technology 7%. More than half of the companies went public in the first 10 years of their founding. Although private equity has become more readily available for some companies, technology companies in particular, postponing a public offering, in my experience, smaller public companies have more opportunity to access capital through public markets than private sources. In fact, I believe the benefits of public capital markets are even more pronounced for small companies because they tend to be more innovative than large companies, and they account for a substantial percentage of the jobs created every year. Public markets give an opportunity for some recouping of early stage investments, incentivize employees through stock options and grants, add economic exposure, and, of course, enhance access to capital for continued growth. I'm securities attorney Laura Anthony, founding partner of Anthony P. LLC and producer of LawCast. Should you have any questions about today's topic, please visit securitieslawblog.com and lawcast.com or contact me directly. Inquiries of a technical nature are always encouraged.